Before we begin, it's important to note that this content is created by AI and may not be 100% factual. It's also not financial advice. Now we're about to embark on a journey through time, tracing the indelible footprints of global index funds. We'll explore their performance, past and present, and even dare to gaze into the crystal ball of their future. So, will index funds remain a solid investment in the years to come? Let's dive into the world of index fund investing and look at the history to try and predict future returns. The concept of index funds was born in the mid-20th century. It was a time of innovation, and the realm of finance was not spared. The pioneers behind this revolutionary idea were John Bogle and Paul Samuelson. Bogle, the founder of Vanguard Group, and Samuelson, a Nobel laureate economist, both believed in the power of passive investing. They envisioned a fund that would mimic the performance of a market index, like the S&P 500, providing investors with a low-cost, diversified portfolio. But their idea was met with skepticism by a financial industry that thrived on active management and high fees. Critics dubbed it Bogle's folly, doubting its potential for success. Yet these pioneers were undeterred. They pressed on, launching the first index fund in 1975. Despite the initial skepticism, index funds have become a popular investment vehicle. Their growth has been nothing short of phenomenal, proving the skeptics wrong and changing the investment landscape forever. What's the philosophy behind index funds? At the heart of this investment strategy lies a simple yet powerful concept: diversification. Instead of trying to pick the winners and losers in the market, index funds spread their investments across a broad range of assets. This approach is akin to casting a wide net in the ocean of financial markets, catching a bit of everything, rather than trying to spear individual fish. By spreading investments across a diverse range of assets, index funds aim to reduce risk and volatility. Another fundamental principle of index funds is the idea of low costs. Index funds are designed to be passively managed, meaning they aim to replicate, not outperform, a specific market index like the S&P 500. Because they are not trying to beat the market, there's no need for expensive fund managers making active trading decisions. This approach keeps costs low, which means more of your investment stays in your pocket, compounding over time. Finally, index funds embrace the idea of tracking the market, rather than attempting to beat it. While this may seem counterintuitive, consider this: over the long term, the market as a whole has tended to rise. Therefore, by simply tracking the market, index funds aim to capture this overall upward trend. It's a humble strategy, acknowledging that predicting the market's highs and lows is a game few can win consistently. But here's the real beauty of index funds. While they may be humble in their strategy, they are ambitious in their goal. Their aim is not to make you rich overnight, but to build wealth steadily over the long term. It's a slow and steady race, but one that historically has proven to be a winning strategy. This philosophy, with its focus on diversification, low costs, and tracking rather than beating the market, has attracted a large number of investors over the years. It's a philosophy that acknowledges the unpredictability of the market while harnessing its long-term potential. And it's a philosophy that, for many, has turned the dream of financial security into a reality. As we moved into the modern era, diversification became even more crucial. The world of investing saw an exponential rise in the number and variety of index funds. This proliferation was driven by the recognition of the importance of spreading risks and maximizing returns across different sectors, countries, and asset classes. Take, for example, the S&P 500, a benchmark that needs no introduction. It's a broad-based index fund that captures large-cap US equities, covering approximately 80% of available market capitalization. It's diversified across all sectors of the economy, from technology to healthcare, finance to consumer goods. But diversification doesn't stop at sectors. Modern index funds also offer investors the opportunity to diversify geographically. There are funds that track indices of emerging markets, European markets, Asian markets, and beyond. This allows investors to spread their investments around the globe, reducing the risk of being tied to the fortunes of a single economy. Asset class diversification is another strength of modern index funds. Apart from equities, there are index funds that track bonds, commodities, real estate, and other asset classes. This multi-asset approach provides another layer of diversification, allowing investors to balance their portfolios according to their risk tolerance and investment horizon. Moreover, the modern era has seen the advent of index funds that go beyond traditional market capitalization weighting. There are funds that follow strategies based on factors such as value, size, momentum, and quality. These smart beta funds offer investors the chance to tilt their portfolios towards specific investment factors, potentially enhancing returns or reducing risk. The modern era has also brought increased transparency and accessibility. Today's investors can easily find information about an index fund's holdings, performance, and costs. They can buy and sell index fund shares with a few clicks or taps, often at low or no cost. Today, investors can choose from a wide range of index funds to suit their investment goals. Whether you're seeking broad market exposure, sector-specific investments, geographic diversification, or a particular investment style, there's likely an index fund out there that fits the bill. The rise of index funds has had a profound impact on the financial industry. These funds, with their broad market coverage and low costs, have challenged the traditional asset management model. Index funds have brought a significant shift in the investing landscape, moving away from active management and towards passive investing. This shift has been driven by the fact that index funds typically outperform actively managed funds over the long term, and they do so with significantly lower fees. The simplicity and cost-effectiveness of index funds have made them increasingly popular among investors, leading to a surge in inflows. This popularity has put pressure on traditional asset managers to lower their fees and provide more value. The rise of index funds has also sparked a debate about the role of active management in a world where passive investing is becoming more prevalent. Moreover, the growth of index funds has prompted a greater focus on market-wide factors and systemic risk. As more and more assets are invested in index funds, the movements of the entire market become increasingly important. In essence, the rise of index funds has forced the financial industry to reevaluate its strategies, reduce costs, and pay more attention to market-wide trends and risks. The financial industry has had to adapt to this new environment, and the changes brought about by the rise of index funds are likely to continue shaping the industry for years to come. The popularity of index funds has certainly shaken up the financial industry. So what does the future hold for index funds? As we gaze into the crystal ball of finance, a few critical factors come into focus. One significant factor that could shape the future performance of index funds is interest rates. As we all know, the financial world is a dynamic one, where change is the only constant. When interest rates rise, borrowing costs for companies increase. This could lead to a decrease in company profits, which in turn could affect their valuation. Now, what does this mean for index funds? Well, since index funds hold a basket of company stocks, a decrease in company valuations could potentially lead to lower returns for these funds. Another interesting aspect to consider is the inflow of investments. In a scenario where interest rates are increasing, investors may be lured towards safer, interest-bearing assets, reducing the inflow into riskier assets like equities. A decrease in inflow could limit the growth potential of index funds. Now let's turn our attention to the S&P 500, a widely recognized benchmark index. To match the returns we've seen in the past 30 years, the S&P 500 would need to make substantial gains. But whether or not it can achieve this is a question that remains unanswered. The performance of the S&P 500, like any other index, is not just about numbers. It's a reflection of various factors: economic conditions, company performance, and investor sentiment, to name a few. So, predicting its future returns is not as simple as looking at past performance. In conclusion, the future of index funds is shaped by a multitude of factors. Rising interest rates, shifts in investment inflows, and the performance of benchmark indices are just some of the elements that could influence future returns. While no one can predict the future with certainty, these factors could have a significant impact on the performance of index funds. We've taken a journey through the history of index funds, but the story doesn't end here. It's a fascinating world, one that's shaped the financial landscape and will continue to do so. As we've seen, index funds have evolved from their inception, through diversification, to their current standing in the modern era. They've made a profound impact on the industry and have the potential to shape future returns. But remember, understanding the history and mechanisms of index funds is just the beginning. The key to making the most of these funds lies in your hands. It's about aligning your investment strategies with your financial goals, staying abreast of market trends, and being flexible enough to adapt when necessary. So continue to learn, continue to explore, and consider how index funds could fit into your financial picture. Thank you for joining us on this journey through the world of index funds. Remember, the future is always in motion, and the most successful investors are those who stay informed and adaptable.